Hi there, everybody. How are y'all? Hey, guys, give me a second. Everybody's just getting in.
I'm right here.
Hey, what's going on, Willie?
Hey, what's up?
Hey, Chanel, can you hear okay? Let me know. Type in the box if everything it looks good for you. What's going on, Willie?
Not much. What's going on with you?
Staying busy?
Yeah, always.
Without Kevin around, there's no food. I'm just like withering away. Hold on one sec.
Yes.
Chanel, just type in it. It's only me and her on the webinar. You got to type it in. But I can see you. Welcome.
Can she hear us?
She asked if I could hear her rather than if she can hear us.
Hey, Chanel, can you hear us? Can you type in the chat box if you can hear us and see us? It's all right if we can't hear you, just if you can see us. All I got was a LOL.
Okay, cool.
Okay.
Hi, hey guys. So welcome. My name is Kunal, and oh, hey, hold on one second. I gotta get Jordan to give me the thing.
I got it.
So, guys, my name is Kunal. I'm the CEO of Bulls on Wall Street, and it's a website that's geared towards trading. And Chanel is actually one of my students that takes our boot camp class, which is a 60-day class designed to teach people how to day trade. But originally, I got into this business in 1999 when I was in college, and the dot-com bubble was just starting to inflate, and I always had kind of an inkling about wanting to try stocks, because that was a time in this country's history where really everybody was trying day trading. You know, the market was flying in ways that nobody had ever seen with the tech bubble and things of that nature, and so I wanted to grab my hands around it. So I was a freshman in college, and I opened a small day trade account, and I just started flipping around stocks. You know, I had $500 in there, and I turned it to $2,000, and then I turned it into $50,000, and then I lost it all when the dot-com bubble burst, because I didn't really know much about stocks or trading. Everybody was getting rich at that time. It was kind of the way it goes, and then when the bubble burst, everybody lost all the money they made, and then some. But I was addicted into stocks at that time. It was consuming me because I saw the potential of it, and so I wanted to relive that glory. And from that day where I lost all that money, I've been trying to relive that glory of that dot-com boom. And so once I lost my money, I actually started right back up. After taking 6 months off and building up some capital. I started with $2,000 this time, and I actually I built my account all the way back up, and then boom, I lost it all in the telecom bust. And in the telecom bust was just a real deadly time for people that trade stocks, because all the things about trading that you're not supposed to do that lures in retail investors happen. And so I made some very tried and true mistakes. And that, you know, one of the things that always gets people when they're investing or trading or anything like that is associating cheap with good. So if something goes down a lot in price, you assume that's a deal because, we're based as consumers to always look for the best deals. And so we assume if something was $100 and it's at $2 in the stock market, well, it's got nowhere to go but up, right? Except, well, most likely if it fell to $2, there's a really strong shot that this thing is a piece of junk and it could go down to $0. And that means you would lose everything. And that's what happened to me in the telecom bust. I invested in a few different companies without really knowing much about it. But I did the same tried and true techniques that we all probably do at some time. I was watching CNBC and I got ideas from there. And I would be talking to people and they were talking about ideas. I was looking for name brands that had gotten really cheap. And that's how I really, really got myself in trouble. So there was a company, I invested in a few different companies. One was Nortel Networks. Another one was Lucent Technologies. And then I had a third telecom stock that was really the one that broke my back, which was a company called Global Crossing. And all these stocks were, $100 stocks. And they came back down. Lucent Technologies, Nortel got down into the pennies. And Global Crossing was another stock that would get down to the dollars, and I bought a bunch. And then one day I saw the CEO on CNBC, and he was talking about all this stuff they have going on, that they had billions of miles of undersea fiber optic cables connecting the world. And I thought, wow, like in today's age, with so much technology going on, connecting the world, that sounds great. 1 billion miles of cable, that sounds amazing. Fiber optics, I have no clue what that means, but fiber optics sounds really, really smart, and this stock is cheap, and it used to be a lot. And so I bought it, and it kept going down, even after this jerk CEO was on CNBC telling us how good this company is. So then what happens with a lot of people, and this is kind of how I got really into studying trading, was what happens a lot of people, so the stock goes from $5 to $3, so I buy some more, right, to get my average down. And then what happens is from 3 it goes to 2. So I buy some more to get my average down. Well, at some point, I don't have any more money to average down, right? That's going to happen. And then the stock keeps going down. And I use a little bit of what's called margin, where you're borrowing from your broker to, average your price down. But at some point, you don't have any margin left. And so when the price gets so low, you have to pay your broker back what you owe them. And so I get a margin call, which essentially means I have to come up with all this cash to give to my broker and sell my stock that I was using for collateral. And so I was busted. I was busted, and it really caused me, that's how I got into trading, because that really caused me to think, like, wow, I bought a good company. I bought good companies, supposedly, and they went down. I bought things that were high and got cheap. I thought I had a good deal, and they went down. I did dollar cost averaging in some manner, and it busted me. And so there were like all these different things that happened to people, and I did the same thing. And I lost it all. And at this point, I had student loans and all of these type of things going on. And boom, my account was busted. And so from that moment, I started to really think, like, well, I have to learn about really what trading is all about. Like, how do you time a stock and get into the market at the right time? How do you time your investments or the vehicles that you buy so that you're not taking huge amounts of risk? And then really, how do you manage your risk? That's what trading and real investing is all about, is getting in stocks and vehicles that you can trade in ways that you can get out easily if the market tells you this is not the right time for that stock, so that you're never taking those big losses. And so that started an endless cycle of learning and trying to figure these things out. And over the years, I got better. And over time, I started to realize that there was a whole world of people out there that were just like me, thinking cheap is good, and buy and hold forever, buy good companies and just sit on them. And what I realized was that wasn't the way to go, because most of us don't have hundreds of thousands of dollars to make 10% a year. if we really want to hit our goals in life and in finance, we need supersized returns with minimal risk. And that means we have to be able to time the market, time stocks, and be able to get out easily if it goes against us. And so this started really just me putting together an endless string of theories and methods that pertain to trading, investing, IRAs, 401ks. I've done the works on how to time these things and how to really supersize our returns. And from there, I opened up Bulls on Wall Street. I opened up Bulls on Wall Street, and it's been geared around trading. And so we have a chat room and stuff like that where I trade in front of people all day. And then we teach classes at night, just like a Chanel. She takes our 60-day boot camp class, which is a class that I teach a couple hours, 4 days a week, and teaching people how to trade stocks. And that's been kind of our growth over the last 6 years that I've had this company. Mary Beth that you see on here, this lovely lady, she's actually was one of my first students. And so many moons ago, about 4 years ago, I had a very young whippersnapper in college that was asking me all these crazy questions about trading and stocks, and that she was really interested in all this. And so I started coaching her, and she became so good that I had to hire her, essentially. And at this point, I didn't have much to give or anything like that. We were a small company, but she was our first building block. I said, wow, why hire people from outside the family if you can get one of your own students? And so, we have now 18 employees, and most of them are all former students of mine. And, we've gone global in teaching people how to trade stocks and then doing different types of classes. And now she's my business partner. She'll give you a little background on herself, too. Go for it, Willie. She just got married, so give her a congratulations if you can.
Yeah, thanks. Yeah, so I was probably like a lot of you. I was just getting out of college, getting ready to go into the working world, and I had an engineering degree, and I was headed to med school. I had gotten into med school, and anyways, I was just curious one night, was searching stocks, looking online, and I came across Canal and came across Bulls, and he hadn't started. Can you hear us, Chanel? She just texted me and said they lost sound. Oh, got it back. Okay, all right, cool. Anyways, I had gotten in med school, came across Canal one night, just playing around on Twitter, and I just started getting interested, and so it kind of started taking over for me. Once you get into stock trading, it's like it becomes your life pretty quickly. And so I wanted to learn about it so bad, and at this time, Canal wasn't teaching classes, but I was just bugging him to death so much every night by email and by phone calls, just asking him questions constantly, and he was like, all right, look, let me just teach you at night. And so I met with him probably for 3 months every night, and he would just teach me what he knew, and so then that kind of started the stream of me being obsessed with stock trading. I didn't go to med school, and I've been doing this full time for about 4 years now. And like he said, there's many avenues of this that you can take. You don't have to trade full time like we do. You can trade part-time. It's called swing trading. So you'll hear people refer to swing trading, day trading. Day trading is what we do, which is it's just quick trades throughout the day. And then swing trading is what a lot of people that have jobs do. And so we teach both of those. Canal teaches both swing trading and day trading.
So let's go into some of these. Chanel had mentioned you guys had some questions, or she gave us kind of a group of questions that to talk about. Hold on, let's get over here 1 second. Dun, 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 dun. Dun, 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 dun. Oh, one sec, screen share. Hey, Lou, why don't you try your screen share? Mine won't come on this thing.
The screen share?
Yeah, for the slides.
Okay, let's see. That work?
Yeah.
Okay. Go for it. Can you see?
Mm-hmm.
All right, you go for it. Go ahead.
Actually, take yours off because every time I speak, it's gonna go to my face. Take yours off. Let me go back on mine.
Okay. There you go.
Boom, boom, boom. Sorry, guys. 1 second.
You get it?
My next name. All right, we're back. Willie, why don't you get started? Chanel keeps texting me and distracting me.
All right. Yeah, I think it might be your internet, maybe. Okay. All right, guys. I'll get started on. So Chanel put together, I think, some questions that maybe you guys had, and so the first one I wanted to go over is what stocks do we trade and why. So what we do is called momentum trading, and even in swing trading, day trading alike, you want to make sure that the types of trades that you're taking have momentum, because those are the trades that the patterns work. Like anytime that if you go online and you search day trading, you'll find all kinds of patterns that people talk about: head and shoulders, breakouts, bull flags, those kind of things. And so those types of stocks, those types of trades are the types of trades that we're taking. But you have to make sure, in order for those to work, you have to make sure that a stock has momentum. And I'm going to show you a couple of charts just to explain what that means. But here on number 2, it says momentum stocks are stocks that are currently making large percentage moves on higher than average volume. So that's really important. Okay, and this is often due to some type of news announcement about the company, positive earnings coming out, something like that. So I'm just going to show you this example of this stock, YRCW, okay? Let's see if I can get it to load. All right, I'll show you this one since it's loading better. Okay, so this is a chart. This is actually a 6-month daily chart. So this is showing what's going on with this stock for over the course of 6 months. Okay, this indicator down here. This is showing you the volume of the stock. And so when we're looking for the types of trades to take, what we're looking for is momentum. And so back in January of this year, right, January until May, this stock, you notice how the volume was really low, right? So this is considered a boring stock that has no momentum. So there's really no trades that come out of this. But then all of a sudden, this little telephone right here means an earnings report. So all of a sudden, the stock reports earnings, and bam, look at the change in volume that happens over the next 2 months, right? The nature of the stock completely changes, and so all of a sudden now it has momentum, and so it goes on this huge run. You see this? It runs from a $2 stock to a $6 stock, primarily because it had earnings come out and it has momentum. And so now the way that we trade, like I said, we trade momentum stocks, but we're looking for flags to form. And so these lines that I have drawn, they're all types of bull flags that have formed. And these lines that are here, the gray line, the yellow line, the blue line, those are called moving averages. And so the stock, once the stock gets in a trend, a lot of times those moving averages, they'll serve as support. And so what you notice every time, now that the stock has momentum, every time it pulls back to this moving average, it bounces, pulls back to the moving average, bounces. And so that's a high probability trade, given that, okay, it has momentum. It's very, very likely that this, pullbacks to the support will bounce. And so it gives you a very good risk-reward trade, because okay, if I buy near support, near this moving average support, it's likely that it's going to bounce like this, right, and run up. And if it doesn't, I know I have a clear-cut stop that, okay, if it breaks the support, then I get out. So that's what risk to reward is. So going back to the slides, we primarily, that's the type that we trade, are momentum stocks. Are you still there, Kunal? Hello? Anyways, I don't know where he went, but yeah, so, okay, unlike some other traders, we don't trade the same list of stocks every day. So a lot of times you'll see people, they'll trade Apple every day or Google every day. And so with us, we're constantly turning our accounts throughout the day. So we're going to be in a stock maybe 1 to 2 days on a swing trade. And we're not trading necessarily the same names every day. We're looking for the stocks that have news out, that have momentum, that they're in a trend. And that's the type of stock that we're playing. So we'll scan each night and look for the stocks that fit our criteria. And in the boot camp that Kunal teaches, he teaches you how to scan and how to find the stocks that you're looking for. Okay, so that's basically, that's a quick overview of the type of stocks we trade. We're not trading options. We're not trading, Forex or futures. But we're trading the actual equity of the stock. Okay. All right. So that was question 1. Kunal, if you're there, come back. I don't know what happened to him. Okay. The next question I think that someone asked was how long do we hold a position? Like I said before, most of our trades that we take are meant to be day trades. You're back.
Yeah, sorry about that. I got a crazy internet problem today.
That's okay.
All day.
Yeah, so most of the trades that we take, they're meant to be day trades. We usually sell them before the close, so we're not holding a lot overnight. And the reason is that when you hold a stock overnight, you incur all of this risk because what happens overnight, right, is news comes out, news in the markets overseas news, and if the markets gap down, it's almost a guarantee that 90% of stocks are going to gap down. So if you're just holding this big portfolio of stocks overnight, your risk is a lot bigger. And so what we like to do is we like to sell out of our stocks before the close. And this is from a day trading perspective. Okay, so that's how long we typically hold our stocks. We do engage in some swing trading. So Kunal, do you want to talk about swing trading for a little bit?
Sure. So, guys, the basis of what we do, okay, the basis of what we do and what almost all great investors and traders do in some manner is they capitalize on trends. So the path of least resistance on any stock is finding a stock that's trending and then riding that trend is the path of least resistance. And the reason for that is very simple. The reason for that is very simple, that stocks in general tend to stay dormant for a long time. They tend to stay dormant for a long time. And then once they start their upward trajectory, and that can happen for numerous reasons, and part of it is, part of it can just be in earnings. Part of it can be some type of earnings. It can be anything like that starts it. And then all of a sudden what you'll see is a stock can be on a trend for years and years. And so our big part of even investing is starting to get into stocks in areas when that trend starts. So you can see what will happen is oftentimes stocks are dormant. Can you see this Netflix chart, Willie?
Yeah.
See, oftentimes stocks will be dormant and they won't do anything. And so you could sit on that stock for literally a year and you won't do anything. And the thing is, when a stock is sitting like this, you don't know if it's ever going to go up, because when a stock has no trend up or down, essentially it's just dead in the water. At some point, it's going to come out of this zone, essentially, of when it's sitting in a very tight price range. See, the stock Netflix was sitting between really $70 and $55 for almost a year. And then right over here, some type of catalyst will cause it to come out of range. And so that's when we start getting interested in a stock, because once a stock comes out of a range that it's been in for a long time, now the potential for a new trend has emerged. And that trend can last for months to potentially even years. And so during the time that a stock is starting to trend, all types of short-term correction. So what I mean by correction is some type of downward movement in price on a short-term basis. Those tend to get bought up as investors and traders and everybody are on the same page, knowing that this is a trending stock, that anytime the price gets cheaper in an orderly type of manner, that it becomes a buying opportunity. That's why you often hear people say, like, buy the dips, like when you have a bull market. And that's the real beauty of, of trend trading. You can see the same thing. So this is like a stock called Priceline. Priceline is a stock, same type of deal. For years, it will do the same. It'll do the same type of thing where you'll just be stuck in a range for quite some time. It'll come in and be stuck in these ranges. And then what happens is when they come out of the range, that's when the aggressive vertical moves start, and that's when you want to start to participate in a stock. Otherwise, all that's going to happen is that you could be stuck in a stock for literally weeks to months to potentially even years. And so the whole point is to stay out of those non-trending periods and start to participate when an aggressive growth in price shows. And that comes from getting these stocks as they come out of these kind of consolidation zones. A lot of times people want to just buy something because it's sitting there and they think it's cheap. But then you've got dead money. As retail people, they don't have access to millions and millions of dollars. We can't afford to sit on a stock that may go up 20, 30% for 6 months. What we need to do is find out that inflection point of when a stock is going to come out of that long-term consolidation, and now that will allow us to participate in a trending environment. And that's the real basis of everything we can do. So these are the marks that you want to take. So when you see stocks that are, we trade a lot of solar stocks, so you can see, like, this is a stock called FSLR. I've had my chat room, since 2008, and I have a gentleman by the name of Skip. He's in my class, and he always asks me, FSLR, when it started to dip down here, every day he'd ask me, he'd say, Canal, man, is FSLR a buy? It's looking cheap. I said, well, Skip, can you quantify cheap? Doesn't cheap just get cheaper? Okay. Next day, hey, man, FSLR went down some more. Is it cheap? He was asking me that because he studied solars, and he was kind of a fundamental guy, and he really liked the idea of solar power. He asked me that at 100, and he asked me that at 80, and he asked me that at 40 and 30 and 20 and 15. And, of course, at some point he's going to be right. But the whole point is we want to stay away from these periods where stocks are either trending down or not trending at all, because you're going to either have dead money or you're going to have money that's getting reduced in a rapid manner. At some point, stocks will start to even out. And then when they finally start to come out of their consolidation zones, and they will rebound off a bottom, that's when you can now get a trending stock. So now you see FSLR, it has been trending now for about 1.5 years. And so see how every time it pops up, it'll dip a little bit. And see those price corrections in the context of a trend do get bought. So, when something gets cheap, it can be a good thing as long as it's in the context of a trend, because then you can minimize your risk and you have the wind at your back, versus what a lot of people think is just, let's just buy something when it gets cheap. And if you do that without context, that is when you can lose your whole investment. My dad was the same way. My dad works at a company called Unisys, and He's worked there now for 30 years, 30 years, and he has his whole life savings in Unisys. And very similar type of stuff happened to him. He had all his 401k. He really believed in the company because, he's one of the managers there. So he believed. He believed. And so in 2008, he was like, "Canal, you got to buy some Unisys at $30." And I'm like, "Dad, man, that thing looks like this is a bear market. In a bear market, your number one goal is to not even be in it. Is when you start to see the signs that the market is weakening, you don't even want to be in it because you have many, many years to grow your accounts. You don't need to be in the market for a long time. The key part, you guys have heard of compounding returns. The whole premise of compounding returns is that you have to compound what? Positive returns. And so compounding returns is very powerful as long as you can stay away from periods of negative growth. And so, for my dad, it was like, he $30, he wanted to buy more, $20, this thing got down to just literally in the dollars. You're talking about your whole life savings, your whole life, 30 years of life worth gone in 1 year. And right, you're never going to get it back. You're never going to get back to 100 when something like this happens. It could take years. And so now, he has some left and he's still just sitting on it. And he's going to sit on it now for probably the next 10 years. So that's, the big thing of what we do and why we want to be playing in trends, in stocks that are trending.
I think they want you to look at Wday.
Okay. And Wday is actually a stock that we trade quite often. So Wday, hold on one second. Wday is a stock that we have actually traded quite often, and we made quite a bit of money actually shorting this stock. So that's one of the beauties of actually being able to trade is that when you can bet against stocks, that's where the real money is happening. So Wday, now Wday has been in a very, very nice trend for a long time. Very, very nice trend. This is a strong stock. One of the things about Wday is they've got also great management team. They always beat expectations. And they're an aggressively growing company. So then what happens is in bull markets, companies, whether they make money or not, doesn't matter as much. It's whether they're growing their business, that aggressive growth. So as long as the market is in a big bull market, these type of companies outperform all the other companies by a huge margin, So this type of company in a big bull market can get you 30, 40, 50% returns sometimes in a year. But what happens with aggressive growing companies that don't really have huge cash revenue, huge cash operating margins in terms of do they make gobs of cash like a Microsoft or an Apple? That doesn't happen because what? They're younger companies that are growing. So once the structure of the market changes, these type of high growth companies get sold off because that premium that people pay for growth, no longer do they want to hold that risk. And so what you can see in Wday is, after this last initial big move, we've started to see an incredible amount of selling come into this, a monster amount of selling. And this has nothing to do with what's going on inside your company. What it has to do is with the structure of the market and what the market values. In times where that the market's in a big bull market, they value growth and people are willing to pay for it. When the market is uncertain and there's more risk at table, people will shun growth and everything that's associated with it, and it will get sold off at just as fast of a pace, if not faster, as it was when it was moving. And so that's what you're seeing right now is a shift in the market from really valuing and giving a premium to high growth companies to those companies that are not making gobs of cash are getting sold off. So like in this time while this was happening, you would see like grocery stores and Walmart and stuff like that Procter and Gamble, they hold up. And the companies like To Wday and these really newer type of companies that have been around just a handful of years, look at them. They get sold off in the most monstrous of ways. You know, another one that we trade that's, you know, in like a similar type of space that moves the same way is like SPLK. You know, SPLK, another stock that ran up to a hundred and something bucks and then got all the way down to the 30s. This is what happens when the structure of the market changes. So now the market has been running for the last couple months, and you started to see the price start to appreciate in To Wday, but not really at the same ascent as it came down. See, and when it was coming down, you're starting to see these huge candles. So this means the stock was dropping $5, $10 in specific days. And as it's been going up, I mean, you're seeing a price appreciation, but not at the same level. And so most likely, this is a short-term correction within the context of this larger down move. And you can see the last few days, the market has sold off just a little bit, and it's taking those high-growth companies off. And so, you know, we're in no man's land on To Wday right now because it's not in a trending environment. You know, once it starts to trend again, you know, you'll have the world at your feet on this type of stock. But now we have uncertainty, so you're seeing much more volatility or get sold off. You'll have a couple months of bounce. And now what's going to happen is if it starts to sell off and it gets back down to its kind of this previous areas, then, you know, you're in a dangerous situation right now. So some levels always just kind of watch. And, you know, stock trading is really about levels, you know. And so you really want to keep an eye on these 65 levels and then this previous high, which is 91. You know, if it can get back above this 91, it might start trending and get back into the 115s. And if it can't, you'll probably see this thing come back down to 65 over time. So no man's land. That's why we want to stick with the trending stocks, because you can predict what they're going to do as the dips get bought. Once that trend stops, now you're talking about much more haphazard behavior. So let's talk a little bit about risk management. You know, risk management. So one of the things that we stress, you know, in all our classes and things of that nature, and I do this even in my IRAs and things like that, is that, you know, if I buy a stock that's an investment or something like that and I really like it, you know, I never will lose more than 10%. You know, that's kind of my baseline number. And the reason for that is that if you lose 40, 50% on a stock, it may take you years to get it back. If you can lose 10%, you live to fight another day. And that's what investing is really about, is taking your shots. But if it doesn't work, you don't marry the position. You know, that's what my dad did, and it cost him everything because he married a position. It wasn't about making money on that stock. At this point, he couldn't admit that he was wrong and the worst of the worst happened. That 1% chance that everything is going to get turned upside down, that perfect storm, actually happened. And he had no plan in place to protect himself. As investors, this is your hard-earned money. And so your first goal always is to protect your hard-earned cash, because you can come back from a small loss of 10% or 5%. What you can't come back from is taking a 50% haircut. It will take you a decade to make it back. And that's what's happening. The people that lost their shirts in 2008, they're just becoming whole again in 2014. Now imagine if you were able to escape all of that in 2008, you just weren't even in the market. Then you know what? The last 6 years you would have been making money and your accounts would be double the size. And that's one of the things, you know, we have like a 401k class that we teach, and that's one of the first things that we look at is we look for signs, and we have some metrics that we track. And when we see it, we are completely out of the market as a whole. And we don't get back in till the market itself starts to really, really flush. And so, you know, if you're looking at a chart, so this is the chart market, every blue moon, you'll start to see some larger corrections where you'll start to see kind of these 10, 15% drops. And as long as it's in the context of, you know, your overall big uptrend in the market, those are the times that we dive back into the market, into our IRAs and 401ks. And then as the euphoria hits, and there's certain metrics that we track and indicators to tell us when the market is just getting above and beyond where it should be, it's getting stretched too high, there's too much euphoria, we start to sell out of our positions, and then we just wait. And one of the things that happens is, you know what, the market may keep going up and you may miss some of the return, but you won't be in the crash. You won't be in that 10, 15% drop, or even worse, every 5 or 6 years, you know, you're going to see much bigger types of drops that you can't come back from. And so you won't even be in the market during these periods of uncertainty. And I think that's a big part of risk management, is figuring out what's your max pain. You know, are you going all the way on it or not? Because remember, compounding returns work best when you don't have periods of negative growth. Dun, 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 dun. Well, you know, one of the things I was also, you know, I also kind of talk about with, you know, I was talking with some of my students about. So they say, well, what do we trade often? You know, oftentimes, guys, there are vehicles called ETFs that trade like stocks that mimic particular industries. And so one of the things that you guys, as people that are working your butts off and you have really busy lives, is that you can use ETFs to track the market, but also to supercharge your 401ks and IRAs. So there's literally ETFs for gold, and ETFs for silver, and an ETF for technology, and coal, and natural gas, and even oil. And so one of the things to always be kind of tracking is, what's trending. You know, what's trending right now, and always kind of stick to those type of sectors. Once they start to trend, then you have an idea of where you want to kind of place your money, and you can use these ETFs. They have ETFs for everything you want to think of. Solar power, wind power, water power, you name it, they have an ETF for it. And so also think about, and so it's not tracking a particular stock, it's tracking an industry. So you don't have to worry about a company's earnings or news, because it's taking an aggregate of the industry as a whole. And so you can buy this and then put it into one of your portfolios, and then ride up, you know, within the context of the trends and things like that. So just keep that in mind. I love using ETFs in my IRA. It's an easy way to not have to sit there and do tons of stock research, but, hey, what's up? But be able to participate with stocks. What is this?
It's good. Try it.
A shake.
Yeah. Sort of.
Yeah, thank you, man. I appreciate it. Anybody got any questions so far? And guys, you know, one of the things that we can even do, and I'll talk to Chanel about, is, you know, we run like some 401k classes and IRA classes and things of that nature. And so, you know, we can totally come in and, you know, teach you guys some of the stuff, you know, that you may want to learn. And you know, our method for even 401ks is pretty cool, because we're able to time the market so that we're in our 401ks at the right moment, and we're out of them, you know, when the worst can happen. I think that's going to be one of the keys to everything you do. And on top of that, we have regular day trading classes and stuff like that also. I can't get my screen share to work, so on that. But you know, you can always email one of us, and you know, we can talk to you guys about it. My email is Or Mary Beth, why don't you bring up a screen with your email or something?
Yep. Yeah, so we do have a class, trading and swing trading strategies, and this class is called the Bulls 60-Day Boot Camp. It's our big class. He modeled this class after the way that he taught me when we were doing our one-on-one sessions when I was just learning, and so he modeled this class after this. And the way it works is you spend the first 3 months. The first month it's live classes that he teaches at night, and he teaches you strategies, risk management, scanning, everything during that period of time. And then the cool part is the second month of classes is when he starts teaching you. He does what's called trade reviews, and you're put on a simulator, so you actually get to start practicing. And we highly suggest it. Like we make our students practice for about 2 months before they go live. And Kanal gives you feedback on your trades. We have a program that you can upload to that we can see exactly what trades you took, and we give you feedback like this is right, this is wrong. He goes over the trades that he took for the day. And so that's really where you start putting everything together. And this is the class that Chanel took from us. You get a course book in the mail. And anyways, it's really good. It's $28.50. You can do payment plans if any of you decide to do this. And it's really the materials that you'll use for the rest of your life. If in any type of investing, you're going to learn stuff that that you'll use forever, and you'll probably become obsessed with it. Anything else? We didn't see any questions. Did you have anything else you want to say? I know we got to end in about 5 minutes.
No, I didn't see anything.
Okay. Yeah, so here's my email. It's marybeth at BL, this right here, and then Kanal's is the same. Like, if you think of a question tonight when you're at home, feel free to email us. We're happy to answer any questions, look at any charts for you, whatever.
All right, rock and roll. Thank you, Chanel. Appreciate it.